the market is beginning to understand that the Fed is beginning to understand. So it has already turned. Maybe it's premature. I don't think it is. Many people say, oh, well, then all this means for your strategy is you need lower interest rates, or else this is not going to work, both on the AI side and on the crypto side. We disagree mightily on that. In fact, we already have proof in 2017 and 2018. Interest rates moved up, and we had two very significant outperformance years, outperforming the benchmarks.
The market is digesting a clear shift. The Federal Reserve recently cut rates again, leaving risk assets looking for direction and underlining how macro policy is now a live driver rather than a tailwind. Many market voices still insist that lower rates are make or break for AI and crypto strategies, but Cathie Wood pushes back hard. ARK's history shows that innovation-led strategies have outperformed even in rising rate regimes, as seen in 2017 to 18. Institutional interest in digital assets has continued to mature this year, with Bitcoin and crypto ETFs drawing record inflows and traditional investors using ETFs as a gateway. The structural demand from ETF buyers has outpaced supply at times, creating strong dynamics for Bitcoin and Ethereum markets. Additionally, regulatory clarity, such as the U.S. Genius Act's backing standards for stablecoins, has improved the landscape for institutions to engage with digital assets. At the same time, traditional finance is increasingly intertwining with crypto. J.P. Morgan just launched a tokenized money market fund on Ethereum, signaling deepening institutional commitment and innovation at the intersection of legacy finance and blockchain. Wood frames Bitcoin as a new monetary system and institutions as the ultimate adopters, with Ethereum's Layer 2 growth and differentiated consumer narratives like Solana reinforcing a multi-layered adoption thesis. So the big question now is, as we approach year-end and market braces for 2026, with some forecasts shifting and volatility still in play, what will market structure, inflows, and regulatory clarity mean for crypto's next leg? Let's watch highlights from Cathie Wood's latest market analysis. Please like, subscribe, and enable notifications for more innovative finance content and expert interviews. Enjoy the video.
I think one number that no one really is focused on, I haven't seen it in the press at least, is the unemployment rate for new college graduates. And that jumped from August to September from 9.3% to 10.2%. Now that's in the double digits. The overall employment rate ticked up to 4.4%. So this is more than twice the overall unemployment rate. And the other thing on the inflation front is oil prices have cracked below $60 as measured by West Texas Intermediate. I think we're in the 58, 59 range. And on a year-over-year basis, that's about a 20% decline. And we're also seeing broader-based declines in rent in the United States, and that will get into the inflation rate slowly but surely over the next year. And then finally, our research is focused on the deflation associated with all of the technologies that we research and invest in. And the deflationary pressures, especially from AI, many people think, oh, these large language models is so expensive, so many GPUs. People using these models and not building them are enjoying, some of it is free. And then there's the step up in subscriptions, but most is free, certainly for the consumer world. And the testing is also free for the corporate world. Well, first of all, let's say that the market is beginning to understand that the Fed is beginning to understand. So it has already turned. Maybe it's premature. I don't think it is. Many people say, oh, well, then all this means for your strategy is you need lower interest rates, or else this is not going to work, both on the AI side and on the crypto side. We disagree mightily on that. In fact, we already have proof in 2017 and 2018, interest rates moved up, and we had two very significant outperformance years, outperforming the benchmarks. Now, we don't measure ourselves against benchmarks, but most other people do. So we give that as a comparison. And it wasn't just in an up year. 2018 was a down year, and ARK outperformed. So I just I want to diffuse that myth, that if interest rates are going up, that ARK's kind of strategy will underperform. That has not generally been so, except for the massive interest rate hike we saw during COVID or in the aftermath of COVID. And by the way, I don't think we'll see that again. And the reason is, while we might have another pandemic, hopefully not, but if we did, I don't think governments would react the same way. They see all of the ramifications that are still lingering. And just like China in 2008, 2009, it was the most disciplined in terms of COVID and not throwing money at it because it had learned from 2008, 2009. I think most other governments have learned from the COVID crisis.
What do you think it could mean for the broader equity markets?
I think that a lot of our strategies, innovation, they are hitting escape velocity in terms of the costs are low enough and the technologies are ready to scale. Unlike in the tech and telecom bubble. What I think for the broader markets, and you can see this in our Big Ideas 2025, in Brett Winton's section, Brett's our chief futurist, we put a table which delineated what we expect in terms of market appreciation from three categories. One was the Mag 6. One was truly disruptive innovation companies, technologically enabled. And one was the rest of the market. Now, consider the source. But if we're right, if our research is correct, and we're both top down and bottom up in coming to these numbers, we believe that the Mag 6, and we take Tesla out, it was banished because it didn't act like the rest of them. We think that the Mag 6 will do fine. We wouldn't be surprised 15 to 25% appreciation. Of course, there's going to be some disruption or disintermediation to their models potentially. So maybe one or two will fall out. We think that technologically enabled disruptive innovation emerging, that will appreciate in the 40 to 50% compound annual rate, again, because they're ready for prime time. And we think the rest of the market, which, is really a representation of the traditional world order, will probably depreciate because technologically enabled innovation is going to disrupt every sector, every industry, every sub-industry. So the wonderful thing about ETFs as a portfolio manager, I don't have to worry about flows. Mutual funds have to worry about flows, when to put inflows to work and how, and they have to meet redemptions as well. With ETFs, the infrastructure around ETFs, and the infrastructure is outside of ARK largely and any ETF provider. So the authorized participants, which are primarily all the brokers out there, and the market makers are managing the flows. Now, so what you do see when I know the most controversial sales are Tesla, for example. When you see Tesla, when you see it taken down, what are we doing? Typically, it's gone through a nice appreciation move relative to other stocks.
Bitcoin is trading into a macro environment that looks increasingly constructive beneath the surface. Labor market stress is rising, with recent college graduate unemployment jumping from 9.3% to 10.2% in a single month, more than double the national rate. At the same time, inflation pressures are easing quickly. Oil prices have slipped below $60, down roughly 20% year over year, while U.S. rents are now falling broadly, setting up a sustained drag on headline inflation into next year. Historically, this combination has mattered for Bitcoin. ARK Research frames the moment as tech-driven deflation accelerating, led by AI. Training large language models is capital-intensive, yet end users get access largely for free, compressing costs and expanding adoption. That mirrors Bitcoin's own structure, heavy upfront infrastructure, followed by near-zero marginal distribution at scale. As technology gets cheaper and usage widens, networks with fixed supply characteristics tend to reprice, not stagnate. ARK's experience in 2018 also challenges the idea that rising or restrictive policy environments doom innovation or Bitcoin-adjacent strategies. Post-COVID liquidity was the anomaly, not the rule. As disinflation deepens and portfolios rebalance into year-end, the question isn't whether volatility returns, but whether the market is prepared for how Bitcoin reprices when macro finally aligns.
I think during the flash crash, one of the major exchanges out there had to sell Bitcoin. This is what always happens. Bitcoin is the most liquid of all of the crypto assets out there. So it usually is the first one to get sold and drag the others down. The others go down more. So we think, and again, we're at a moment where we think we've seen the bottom because the news is out. JP Morgan posted the report about MSCI. Now everyone knows that. Everyone knows about the flash crash. And, while Binance is very, very profitable, I think there are memories of Bitfinex, which have left scarred tissue and, the ramifications thereof. So we think from the beginning, when we talk about Bitcoin, we say, look, it's a very big idea. It is a global monetary system. It is a technology, and it is a new asset class. It's leading the charge into a completely new asset class. So it's the leader. And it's where all institutions are going to dip their toes in first. So that one has to be at the top of the list, just in terms of the big three. I think in terms of Ether and Solana, the narratives are shifting a little bit. Absolutely, Ethereum is what institutions are choosing as they're building on top of the Ethereum layer 1 with layer 2s. Now, the big debate out there is, are layer 2s, and, they're proliferating widely now. Are they going to commoditize because they're not close enough to the consumer, except for Base, which is Coinbase is one. They're not close enough to the consumer, and they're dependent on the layer 1s. So over time, as these proliferate, is there going to be a commoditization, and the value will flip to those closer to the consumer and to the layer 1s? We're thinking that could be the case here. But all that said, the proliferation of building layer 2s on Ethereum continues. So that would be our second choice. And really, it's, I think, as I described on the last call, really an institutional play. And then Solana is more the consumer play, though, of course, it also would like to be part of the institutional scaling of crypto. So we shall see there. And of course, Solana is just a layer 1, so much simpler. So I think those are the big three. In terms of equities, and you'll see in the flagship strategy, we cannot hold the pure plays in terms of ETFs. In other strategies, we can. It's just what our clients would and would not accept as we were evolving our strategy. And so we have to rely on the stock. So you'll see Coinbase is right up there. It's number one. Robinhood is number two in terms of it is moving quickly towards the digital wallet space and understands this is the game. Who's going to have that digital wallet? And then you'll see us trying to expose our clients to stable coins. So Circle is that one further down the pack, and a little bit of Ether and Solana. So I think including the last two, one is very small, the Solana. For technical reasons right now, it's still in pre-registration. And the Ether one is around 2% of the portfolio. So taking crypto all together, we're probably talking about a 12-13% position in the portfolio. And that feels the right size. Let's see how this recovery tests the various technicals and if decisions by institutions like the wirehouses, Morgan Stanley, B of A Merrill Lynch, Wells Fargo, UBS, if any of them decide to put Bitcoin on their platform through the ETFs. They have not done so yet. So we're waiting to see when that happens. And they may have been waiting for this 4-year cycle to play out, right? Because that's what they've heard since the halving. And now we're seeing a down round. Let's see if they step in. We don't know. So what they're saying is we have approved this spot ETF. It can be spot Bitcoin, spot ETH. We have approved this on our platform, and you can put it in your models. And you can buy it for your PAs, your personal accounts. So it's a pretty big deal, and it's really demand pull from the advisors if they want it, if their clients are clamoring for it, saying, "Hey, now is the time. Let's get into these new assets."
Cathie Wood pointed out how, during the recent flash crash, one of the major exchanges was forced to sell Bitcoin. As the most liquid crypto asset, Bitcoin typically gets offloaded first, dragging the rest of the market down even harder. She believes the bottom is now in sight, with the news fully out. Binance remains very profitable, but memories of Bitfinex's past troubles have left lasting scars and ongoing ramifications. Cathie Wood described Bitcoin as the ultimate big idea, a global monetary system, groundbreaking technology, and the leader charging into an entirely new asset class. Institutions will dip their toes in here first, making it the top priority. Among the big three cryptos, narratives are evolving for Ether and Solana. Ethereum attracts institutions building on its Layer 1 foundation, fueled by a proliferation of Layer 2 solutions. She raised a key debate, though. Will these Layer 2s commoditize over time? Most are too far from consumers and depend heavily on Layer 1s, which could flip value to those closer to users or the base layers themselves. Despite that, Layer 2 growth on Ethereum keeps surging, positioning it as her solid second choice, mainly an institutional play. Solana, by contrast, focuses more on consumers while aspiring to institutional scaling. Its straightforward Layer 1 structure simplifies things. In equities, the flagship strategy can't hold pure crypto ETFs due to client preferences, so it relies on stocks. Coinbase leads as number 1, with Robinhood in second place for its rapid push into the digital wallet space. That's the real endgame. Further down, Circle provides stablecoin exposure, alongside a small 2% in Ether and a tiny pre-registration position in Solana for technical reasons. Crypto makes up about 12 to 13% of the portfolio overall, which feels like the right balance. Wood is monitoring the recovery against technical levels and watching decisions from heavyweights like Bank of America, Merrill Lynch, and Wells Fargo. What do you think? Will institutional giants like Morgan Stanley finally approve spot Bitcoin ETFs in this cycle's dip, or are they waiting for the next bull run? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.